If you think 2023 was hard to get financing, wait till 2024. Ehren and I are actually breaking down everything you need to know about investing in 2024, what trends, what products, and what rates we're expecting to have throughout the next 12 months.
Hey guys, Aaron and Josh back here with another video. Today we want to touch base on what our thoughts are going to be for investing going into 2024. We're going to touch on residential, we're going to touch on multifamily and commercial, taking a look at office conversions and some development stuff for you as well too.
It's needless to say, 2023 was a wild ride. I think, we've seen some unprecedented rate hikes. We saw people transition into, investing to stabilizing, possibly selling. So a lot of things have happened this year in the market. For the ones who were able to situate themselves in a great spot, it's never been a better time to buy. People always say date the rate, you make all your money on the buy. We're moving into a time now where being able to make money on the buy is a reality again. It wasn't necessarily reality back in 2 years ago when you had 50 people trying to buy a property and you had going $200,000 over asking. Like, that wasn't a great time for an investor to be able to acquire an asset. We're moving into a time when it actually is. So it's interesting to see how people are going to be changing their investment strategy in this market. And we're here today to tell you guys a little bit about as first-time home buyers, as investors, how you can go about taking advantage of this market. So let's dive right into it. First things first, great time to be a first-time home buyer. If I could qualify as a first-time home buyer, today or this season would be a great time to purchase because a few things. One, it's a buyer's market. You have the ability to dictate the terms in which you want to purchase. You're probably not going over asking. You have the ability to be able to extend closing. You can take on times in which you don't have to waive your conditions, and you have an opportunity to be able to actually purchase a property for under where the market has been in the last few years.
Yeah, I think when we take a look at everyone who bought in the last few years and where they're at, holding on to it with their debt servicing and their cash flow and the stress on their own financials right now. A lot of the conversations that I'm having, and I'm sure you and some of our other agents are having, are about offloading properties and helping current property owners deleverage and how to make their cash flow a little better. And there are people starting to put these properties on the market, and with the way the market's been and where the prices are and the correction, when we're taking a look at like where you're buying in terms of market values, the values are definitely down right now. And like Josh said, you have the ability to negotiate. Being in a position to buy in a buyer's market isn't necessarily always about interest rates being at 2%. Sometimes it's about all the other benefits that you're able to get throughout the negotiation process of actually buying that home. If that's going to give you more time to get your financing, give you more time to do due diligence, maybe you're selling a property and you're looking to upsize or downsize, whatever that is. Maybe that gives you more time to be able to find a buyer for your current property and secure that bridge. So, there's lots of other advantages that come with today's market, other than just taking a look at it from a rate perspective.
Yeah, an interesting market dynamic is the people who are selling right now. They're selling these smaller multifamilies. They're the ones who had maybe 4 or 5 properties and they're starting to maybe feel the pinch a little bit and they're looking to sell off their duplex or they're looking to sell off their triplex. And as a first-time home buyer, the trend is now buying something that has an additional unit or has 2 units to be able to help with, qualifying for that mortgage. So if you are looking to make a purchase, it's a great time to make money on the buy and date the rate. The rate isn't always going to be this high forever. Real estate moves in cycles, and as it moves in cycles, rates go up and rates go down. So if you're able to make money on the buy, phenomenal time to do so if you can qualify. The trick is qualifying. If you can get a cosigner to help you qualify, if you can find additional units in a property to help you service that debt as you are navigating through this high interest rate cycle, great time to buy.
Yeah, if you're a first-time home buyer, you don't have to take, a 5-year insured rate. You could take a 3-year insured rate, and you could take a look at, refinancing or switching that debt out in the next 2 to 3 years once interest rates come back down. So, kind of get over that rate area and where we're at, understand that we're not going back down to these 2% rates. It's not something that we're going to see. Rates will come down in a little bit, but if you can get into a property now and you can hold on to that higher interest rate, the benefit down the road is going to be astronomical.
Completely agree. Now when we're looking at investment into residential real estate, flipping was a hot topic at the end of 2023, all 2022. And we're starting to see a resurgence of a little bit. There are some really good deals to be had from people who are maybe, selling projects half finished. Guys who took on more than they could chew and who are getting rid of properties. We're seeing lots of them right now. So if you are somebody who is really dialed into a certain area and you understand the actual current value as of today, and you have the capacity and ability and capital to be able to do a project, we're starting to see a ton of really good projects. And I foresee that you're going to see more of these opportunities show up in the next 12 to 24 months as more inventory hits the market and people need to sell.
Yeah, I think now's the time to really start connecting with your realtors and connecting with guys in the construction, other flippers, guys that you're going to want to have first access to these deals as they start to hit the market. With where we're at in the real estate cycle and moving towards a lower interest rate environment over the next few years, with people deleveraging and with people, might have been in a position where they bit off a little more than they can chew on some of their construction projects. If you can get those projects before they hit the market, obviously it's going to give you a high value add to your network with your professionals. And, with the lack of, inventory at the market right now, once things hit the MLS, they're going pretty quick. The good deals are going quick. So, if you haven't been working on your realtor referral networks, I'd say now is the time to really start reaching back out there, having those conversations, seeing what they're seeing in the market, and just let them know that you're in a position to buy. And these realtors usually have someone that bit off more than they can chew or is looking to deleverage. And if they can come to you first before it hits the MLS, as always, it's a great position to be in.
Yeah, and I think to note as a retail investor, as somebody who's looking to get into the market, stop listening to the news. It is there intended to scare you. There are opportunities out there. Obviously, don't put yourself in a position where you can't afford the property you're looking to purchase, but the ones who make money are the ones who purchase in markets like this. So, situate yourself properly. Have capital on the side ready to make a move. If you are finding opportunities and then trying to figure out your capital position, you're too late to the party. Somebody already has capital on the sidelines waiting to purchase in this market. So if you are looking to have a conversation about what does that look like to get yourself ready for purchasing one of these properties, reach out to your trusted real estate professionals. They can let you know how you go about purchasing them, what product you need to use, and how much capital you're really going to need to be able to acquire an asset like this.
Yeah, I think it's a good time to really just start understanding how things work in real estate. Understanding why rates move at certain points. What are the bond yields? How are variable rates moving? What is the real estate cycle? What are the ups and downs? How often does that happen? What does that look like? The news just projects what's the hot topic at the moment, like Josh said. But for you to be able to navigate that and go past just what you're hearing on the news, you really have to understand the market and how it works. And not only is that going to help you make a more business-based decision when you're purchasing your real estate, but it's going to make you feel a little bit more comfortable, and it's going to allow you to project out your business plan over the next 10 years versus just trying to kind of live day to day and make your decisions based off kind of what you're hearing in the environment.
No, I completely agree. When we look at the retail investors who are purchasing smaller properties last year, a lot of them have pushed into the mid-size multifamily space, 5 to 10 units. And that market seems to be, or was really saturated in the last 12 months. We are starting to see more sellers offer really great deals. The cost per unit is coming down everywhere. The people who were looking to sell and who wanted the whole world are now a little bit open to vendor takebacks. They're open to longer closings. They're open to giving you access earlier. There's a lot of flexibility in the market right now for people who have the capital to acquire these assets. And as we look into 2024 and what that looks like for the potential buyer, you are now in a situation to find a really good deal.
Yeah, I totally agree. And I think, if you listen to our last video when we were talking about CMHC policy changes coming to refinancing out of these repositioning loans, we might see some of these more turnkey properties hitting the market sooner than expected, simply because, the investor doesn't have the capital to carry it for another 24 months, which is going to be good for the turnkey buyer. I think looking ahead for multifamily, and if you're buying today in a high interest rate environment, look ahead 5, 7, 10 years, as these interest rates come back down to a more normalized rate, your cap rate is going to shrink as well too. So if you're buying today, at 7.5% interest rates, when these rates come back down to a more normalized value and these cap rates shrink, that's a huge profit margin and a huge value increase over the next 5 to 10 years. So if you have the capital right now to be able to sit through these higher interest rates environments, the benefit on the outside is going to be huge.
Without a doubt. And, if we take a look at where, the metrics that most of our investors use to purchase these types of assets or make decisions on purchasing these types of assets, we look at a few things. We look at population increase. We take a look at rates, and we take a look at products available to actually be able to purchase and develop these properties. And the metrics that are coming out right now in regards to the deficit on rental housing, it's astronomical. We can't get enough supply in our market to be able to service the rental units needed to be able to bring rent down. So if you're going to purchase a property that the value is directly correlated to the net operating income, and we don't have enough supply in the market to be able to provide that to the people who are looking to rent is going to continuously increase. And as rent continuously increases, the value of your asset will continue to increase. So if you're in a situation right now where you have dry powder, which a lot of our clients last year restructured debt, they put money on the side waiting for this opportunity. If you have the opportunity to do this and to take on the high carrying cost of the debt, and you have the opportunity to develop these types of properties, throughout the next decade, I foresee at least that the value of these assets will exponentially increase as rent increases throughout the economy, because we can't service the amount of units required to actually deal with the population.
Yeah, another thing we want to touch on is taking a look at some of the density changes and municipal bylaws that have come to effect over the last, I guess, about 6 months now, 5 to 6 months. So we're seeing a lot of cities now allowing for what was single family to be 4 to 5 units, so density changes there. We also had Bill C-23 come out where SBA process is essentially expedited or almost eliminated for these 10 and unders. You no longer have to worry about parking. There's only one level of approvals. These expedited process and these density changes, I think, presents a really large and strong opportunity for infill projects. Kind of continuing on what we just touched on with cap rates and interest rates. Again, if you're building something at today's market and you're building in these 7.5% interest environments, higher cap rate environments, again, if you're building to hold on to, and you hold on to these projects for the next 3, 5, 10 years, again, you're going to be in a really strong position to see a huge value increase come from these projects, which is going to be a great opportunity for development investors in the market.
I completely agree. I think that there are, from the conversations we had from our lenders right now, there is a lot of capacity, and they're getting ready for the new phase of development coming into Ontario. The federal government is preaching brand new purpose-built multifamily. All the mortgage investment corporations and capital firms that we're speaking to about getting ready for this, they are planning for this because they anticipate that construction is going to be a massive part of the economy over the next decade. And if you guys are looking to get into construction or you're wondering about how that works, there are different essentially tiers to it. There are conventional tiers, and there are private mortgage investment corporations, and really just depends on how much money you have and how much experience you have. If you got both, you're good. If you don't have one or the other, you might be looking at an alternative option. But there's lots of money in the market. Don't listen to any of the fear mongering. There's lots of capital in the market for good deals and for people who are experienced, who have the ability to be able to execute on these projects. So we foresee infill development, especially 10 units and under, not having to go through site plan anymore, continuing to be a trend that is going to push through into 2024. I have a handful of clients who have gone through it. The takeout financing is really the most important part. You may have a slight more amount of equity in your property at the end of the project. You might have to wait till the end of the term of your takeout financing to be able to really recoup all of your investment capital, just due to where rates are at if you're looking to refinance conventionally. But again, lots of capital in the market, lots of opportunities for these developers who are looking to take on these projects.
Yeah, I'd say the only thing that I'd really add to that is just if you are looking to build these 10 and under type projects, 5 to 10 units specifically, CMHC construction loans, they want to see that loan value around that, $8, $9, $10 million. So if you have these $1.5 to $3 million construction projects, expect that you're going to be in some sort of alternative, or uninsured type financing. Probably not going to be getting CMHC financing. Again, if that loan size is closer to that $10 million mark, then you're in a much better position. But like Josh said, capital and experience are going to be the two biggest factors that are going to go into this. So when you're putting together your team and you're making sure that you have the necessary requirements, reach out to us. We can definitely help guide you and make sure you're in position for success.
Yeah, no, great point. We got a ton of calls about wanting CMHC financing on construction for like $3 million deals. And unfortunately, it's just not viable just considering how they go about issuing the debt and buying the bond to insure the debt. So great point. Last but not least, there are a bunch of brand new or new-ish kind of trends that are emerging out of COVID and out of the high interest rate environments. The landlord-tenant board isn't necessarily nice to current landlords in Ontario. So one thing that we're seeing is office conversions. Really cool kind of play on downtown cores. After COVID, a lot of employers moved away from the massive cost of owning offices. And we're starting to see these downtown cores have this empty office space that they're selling, and investors are looking at it with the ability to be able to create residential units. We're seeing that more and more, and we're also seeing like municipalities actually incentivize investors to create these units. I believe Sudbury has a $20,000 per unit grant that they give investors for every single residential unit that's created. There are some really good deals for people who are looking to purchase these types of assets. It does take a significant amount of capital though, and your capital and experience, a lot like construction, will go hand in hand into actually being able to do this project. Really interesting kind of way in which investors are finding opportunity in this market.
Yeah, when we're looking at financing these types of conversions, again, taking a look at the dollar size and where that's at, an actual conversion project, probably not going to be getting any sort of like CMHC financing regardless of how high the loan size is. I mean, it may depend on how extensive the renovations are and what's all going into the project, but you're probably going to be looking at some sort of private or alternative debt in the meanwhile. Now, that doesn't mean that you can't exit out into CMHC, so we can always take a look at that on the refinance. CMHC does accept mixed-use type properties, so you can have some office retail in there. As long as you meet all the guidelines, 30% of the square footage, must be or less, I guess, is allocated to the office. And if you have a type of project like that, again, just reach out. We'll make sure that everything fits the requirements. But CMHC option definitely available on the refinance. Touching on the financing. So again, typical construction financing. If you're looking to get into the project on acquisition, if you're going directly into a construction type loan, expect to have your loan to value somewhere around 65 to 70%. So that means you're going to have 30 to 35% down. But that also means on top of that, you're going to have 15 to 20% of your budget as a capital requirement as well too. So, getting into these infill, conversion type projects, upside is really great, but so is the amount of capital that is required on hand. Again, higher down payments, also going to have that capital reserve. Taking a look at, you bring on a GC, what are the additional costs there as well too. A lot of these office buildings, especially in areas like Sudbury, they're probably older buildings. So, you're going to have probably an environmental, some sort of building condition report. So again, you're a little bit higher expense costs. If you're taking a look at using any sort of like energy efficiency program, getting into CMHC, just understanding that the reports here, they are pretty costly. They typically start around $7,000, give or take, and then depending on the size and how much help you need from the engineer, they could get a little bit higher. So again, the upside on these is huge, but so is the upfront cost.
Yeah, they are decently extensive to be able to actually complete. But again, if you're creating 30 residential units in a building that you purchased for $1 million, the lift on these assets is incredible if you can do it. It does take some time though, because if you're doing something above 10 units, you have to go through site plan. If it's a completely empty property, keep in mind that you have a carrying cost on that private debt as you're in it as you're getting through site plan. Odds are you're not getting a site plan approved project that is office conversion, so you're going to have some time in there of capital cost to be able to burn as you're going through that. So it is capital intensive, but A lot of investors are looking at this as a way to be able, a cheaper alternative to actually being able to build a brand new building. And depending on where you're actually buying and what you're doing to the project, it could be a great way to be able to deploy capital in 2024.
Yeah, wrapping that up, basically wrapping up 2023 at the same time. 2023 was a bit of a tough year. I think it provided a lot of learning lessons and a lot of growth opportunities for newer and mid-level investors, and just trying to understanding that the real estate market, it's not perfect. It does have some weaknesses that come with it. It's not a forever upwards trajectory in terms of prices, and a forever low interest rate market. So, for those that are going through your first kind of cycle, make sure you take away the learning lessons, make sure you grow from it, and use those opportunities to help you become a much more successful investor, moving forward with your career.
Yeah, if you guys enjoyed this video, we really appreciate if you hit the like button, hit the subscribe button. It allows us to make more content like this for you. If you have any video ideas or have any questions about this, feel free to reach out to either Aaron or myself. We're happy to answer any questions you might have. Really appreciate you reaching out and watching.